XRP is showing something unusual in the data right now. Real-world asset tokenization on the XRP ledger has expanded from roughly 50 million to over 5.1 billion in under a year, and the flow dynamics behind it are accelerating faster than expected. What matters now is not price movement, but whether institutional capital is beginning to structurally rotate into tokenized settlement systems before most of the market recognizes it. In this breakdown, you'll see what is actually driving this shift, how institutional infrastructure is being built around it, and why tokenized assets may be entering a new phase of adoption. The XRP ledger real-world asset ecosystem is now sitting at approximately 5.1 billion in tokenized value, including stablecoin liquidity and early institutional flows. But here's what most people miss. There is no longer experimental blockchain activity. It is infrastructure-level integration, beginning to interface with traditional financial systems. Across institutional conferences like Money 2020 Europe, the conversation has shifted away from whether blockchain works and towards how quickly custody, settlement, and treasury systems can be deployed on-chain. Banks and financial service providers are now actively designing implementation frameworks instead of testing isolated pilots. And when that shift happens, markets often move from narrative-driven cycles into infrastructure-driven cycles. Short-term volatility remains, ladies and gentlemen, but the underlying system structure is beginning to evolve. For years, blockchain was treated as a speculative overlay on traditional finance. But the XRP ledger's expansion into real-world assets suggests something different is emerging. From tokenized treasuries to stablecoin liquidity, the system is now being used as a settlement layer, not just an investment layer. Ripple-linked ecosystem data suggests growth from 50 million in early 2025 to 5.1 billion today. That represents a 100X expansion within a single cycle window. Write that down. And while projections towards 500 billion remain speculative, the direction of institutional engagement is becoming more defined. Real-world assets represent traditional financial instruments issued on blockchain rails. This includes government debt, instruments, money market funds, fiat-backed stablecoins, and tokenized liquidity products. The core shift is not speculation. It is settlement efficiency, faster clearing, lower friction, reduced counterparty dependency, and continuous market access. But the deeper transformation is structural, ladies and gentlemen. Let that sink in. Once assets become programmable, financial systems begin transitioning from static infrastructure into dynamic liquidity networks. Quick disclaimer, this content is informational, education, and entertainment purposes only, not financial advice. Never invest based solely on a YouTube video. With that said, let's continue. Across global financial forums, a clear pattern is emerging. Institutions are no longer debating blockchain relevance. They are actively building deployment strategies. Key focus areas include custody frameworks, stablecoin integration, treasury automation systems, and tokenized asset issuance. Participants now include global banks, fintech providers, and payment infrastructure firms. This is no longer early-stage experimentation. It is execution phase, architecture design. Now, this is what most people miss. Infrastructure adoption always precedes public visibility. Think about in the 19th century. Telegraph transformed global markets by compressing information transmission times. Before it, price discovery was slow, fragmented, and geographically inconsistent. After its introduction, markets became synchronized in near real time. Capital efficiency increased dramatically. Arbitrage opportunities collapsed, and global financial systems became interconnected. The key lesson is not the technology itself, but the compression of time in financial settlement and information flow. Blockchain introduces a similar structural compression, this time in value transfer rather than communication. If you're enjoying breakdowns like this, make sure to like and subscribe. It helps the channel a lot. Now, with that said, let's continue, because this next part is where it gets more important. Recent data suggests approximately 1.5 billion in real-world asset inflows into the XRP ledger over a 30-day period. Meanwhile, Ethereum-based tokenized asset segments have seen net outflows in certain categories. Ethereum still maintains a large ecosystem base, but marginal flow direction matters more than total size. because financial systems evolve through capital movement, not static valuation. Capital typically rotates towards systems perceived as more efficient, scalable, institutional aligned. Now, this is what most people miss. Narratives follow liquidity flows, not the other way around. One of the primary constraints on institutional participation has been regulatory uncertainty. Financial institutions do not adopt technology based on capability alone. They adopt it based on compliance certainty. When legal clarity improves, participation does not gradually increase. It often accelerates in phases. The Ripple-related regulatory environment has been a key variable influencing institutional hesitation and re-engagement cycles. This is why regulation functions not as a background noise, but as a structural adoption gate. This is super important. Let that sink in. A consistent pattern in financial systems is divergence between retail and institutional behavior. Retail participants tend to respond to volatility and sentiment shifts. Institutions respond to structure, liquidity, and long-term integration potential. When derivative exposure resets while infrastructure continues expanding, it often signals repositioning phases rather than terminal market cycles. Short-term price movement does not necessarily reflect underlying system development. In the 19th century, railroads redefined economic geography. Cities connected to rail networks experienced accelerated growth, while disconnected regions lagged. The value was not the trains themselves, but the connectivity layer they created. Capital naturally flowed towards infrastructure nodes with higher connectivity. Blockchain systems may now be entering a similar phase, where the value accrues not to isolated assets, but to networks that function as financial settlement rails. Stablecoin liquidity on the XRP ledger has shown meaningful expansion. Estimated supply has reached hundreds of millions in value, with rapid percentage growth in short-term timeframes. This matters because liquidity is the foundation of functional tokenization. Without liquidity, assets remain theoretical. With liquidity, they become usable financial instruments. Sustained liquidity expansion is often a prerequisite for institutional scale adoption. Ripple's ecosystem development has focused on institutional-grade infrastructure layers, including custodian settlements, treasury automation tools, enterprise wallet solutions, and liquidity routing frameworks. These components are not designed for retail usage. They are designed for financial institutions, requiring compliance, security, and integration compatibility. This reflects a deeper strategy shift from product creation to infrastructure embedding. The Bretton Woods Conference in 1944 established the foundation for modern global financial coordination. Its impact was not immediate, but structural. Over time, institutions, currencies, and trade systems aligned around the framework it created. The key lessons is that financial systems evolve through architecture first, and visible outcomes second. Infrastructure determines long-term behavior, not short-term narratives. See, large-scale settlement systems such as DTCC process quadrillions in annual security flows. Emerging discussions around distributed ledger technology highlight potential integration points between traditional settlement systems and blockchain-based infrastructure. Ripple-linked systems are positioned within this broader conversation through custody brokerage and enterprise settlement integration pathways. The significance is not speculative. It is structured compatibility with existing financial rails. Future regulatory clarity remains one of the most important variables for institutional expansion. Clear legal classification frameworks could accelerate onboarding of tokenized assets and settlement systems. Uncertainty, by contrast, slows institutional deployment regardless of technological maturity. This makes regulation a primary structural variable in adoption velocity. Market cycle perspective. Historically, XRP and similar digital assets have experienced extended drawdown cycles followed by rapid expansion phases. Current market conditions show shorter correction duration and increasing institutional infrastructure presence compared to previous cycles. However, historical cycles should not be assumed to repeat identical due to new variables such as ETFs, custody infrastructure, and regulatory evolution. Let's talk about structural signals versus temporary signals. See, temporary signals include price volatility, sentiment shifts, and short-term narratives. Structural signals include liquidity expansion, institutional infrastructure development, custody integration, and regulatory frameworks. Temporary signals attract attention. Structural signals determine long-term system evolution. This is the bigger picture. The XRP ledger narrative is shifting from speculative asset discussion toward infrastructure-based financial integration, from isolated blockchain activity towards institutional system embedding, from experimental technology towards operational financial infrastructure. Whether this transition results in dominant adoption or multi-chain coexistence remains uncertain, but the direction of movement is increasingly visible. The XRP ledger ecosystem now sits at the intersection of tokenized assets, institutional liquidity, regulatory evolution, and global settlement infrastructure. Long-term outcome is not guaranteed, but institutional engagement is no longer theoretical. It is operational. And when financial systems begin integrating new settlement layers, change tends to unfold gradually, then suddenly. Prices reacting, systems evolving. I always tell you to pay attention to what's quiet. And global financial infrastructure may already be shifting beneath the surface. If you found value in this breakdown, subscribe for more institutional-grade financial analysis, because the goal is not to follow narratives. It is to understand the systems generating them, the liquidity flows, the infrastructure layers, and the institutional positioning shaping the next phase of global finance. The transformation is not coming. It's being built in real time. Pay attention to what's quiet, ladies and gentlemen. Hope everyone's having a great day. Nice afternoon. Some of the news: an Apache helicopter was shot down. The pilots were rescued. Looks like there's going to be some form of response to this. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Oil really had something to say today as far as we're concerned in the DXY. Ladies and gentlemen, if you want to learn how to trade, if you'd like to learn how to invest, if you want to learn how to make sense of all this, come and join the Crypto Public Desk Monthly. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all of this, come and join over 570 active traders and investors. The market completely missed the biggest story in oil. It's not Iran, not the Strait of Hormuz, not OPEC, not China. Because while everybody was obsessing over supply disruptions and drawing charts projecting $200 oil, something extraordinary was happening beneath the surface. See, the world's largest energy importer simply stopped buying, and nobody's paying attention to this. So if you think about that for a moment, the country that consumes more crude than almost anyone on earth saw imports collapse by roughly 23% during one of the most geopolitical, dangerous periods for global energy markets in years. Most investors have barely noticed this. The consensus narrative was very simple. Middle East tensions rise, shipping routes become threatened, oil explodes higher, inflation returns, markets panic. But reality did not cooperate with the narrative. Oil never reached the levels many analysts predicted. In fact, the market absorbed one of the biggest geopolitical shocks in recent memory, far better than expected. The obvious question is why? The answer takes us into a much deeper story about how China's economy has been quietly transforming over the last several years, because this isn't simply about oil. Ladies and gentlemen, I always tell you to pay attention to what's quiet, and this is what's quiet. As financial mercenaries, we pay attention to things that most people won't, because we focus on the satellite perspective, how everything's interconnected, the flows. See, it's all about energy. It's all about industrial strategy. It's all about inventory cycles. And ultimately, it's about understanding where the next major demand shock could come from. Let's start with some numbers. Back in 2022, after Russia invaded Ukraine, China responded in a very predictable way. Imports surged, oil purchases jumped, approximately 45% above the pre-conflict trend. Beijing saw uncertainty and immediately moved to secure supply. That was the old playbook. Everybody knew that. None of this is financial advice, just my own opinion, and retains any capacity. This time, it's very different. Instead of aggressively buying crude, China reduced imports. That tells us something very important. The leadership in Beijing believes its energy security position today is dramatically stronger than it was 4 years ago. And when you start looking at the data, it becomes obvious why. The first factor is electrification. China has spent years building renewable energy capacity at a scale that frankly has no historical comparison. Solar deployment, wind deployment, battery manufacturing, electrical vehicle adoption, grid infrastructure. See, all these trends accelerated simultaneously. The result is that China has gradually reduced its vulnerability to external energy shocks. Every electric vehicle replacing an internal combustion engine reduces future oil demand. It also has a demand reduction in metals. We went over that in the previous video. Every additional gigawatt of renewable generation reduces dependence on imported fuel batteries. Every battery installed creates another layer of resilience. This does not mean oil is irrelevant, far from it, but it does mean that China can absorb energy shocks in ways it simply couldn't a decade ago. The second factor is stockpiles, and this is where things become fascinating. Following the 20th Party Congress, Beijing intensified a broad national strategy centered around self-sufficiency and strategic resilience. Many investors understand this when it comes to semiconductors. Many understand it when it comes to rare earths. Far fewer appreciate what has happened across commodity markets. China's been stockpiling oil, gold, agricultural products, industrial metals. Strategic reserves have expanded significantly. In simple terms, China prepared for exactly the type of geopolitical environment we are living through today. When prices become attractive, Beijing buys. When prices become elevated, Beijing can draw from reserves. The flexibility matters enormously, but even that isn't the most interesting part of the story. The real surprise is what happens inside of China's industrial system. Nobody's paying attention to this, because it's really boring. It's like watching paint dry. See, petrochemical inventories. This is the part that nobody is talking about. For years, analysts have complained about excess capacity in Chinese manufacturing, particularly in petrochemicals. The criticism was that China has built too much, too many facilities, too much production, too much inventory. But what if those inventories suddenly became a strategic asset? Because that's exactly what appears to have happened. Large stockpiles of oil-derived products allowed industries to continue operating without requiring the same level of fresh crude imports. Think about the implications of that. See, instead of buying expensive oil on global markets during a period of heightened uncertainty, manufacturers simply utilize existing inventories. That's not a collapse in industrial activity. That's not necessarily economic weakness. That's inventory management. And inventory cycles matter enormously because they eventually reverse. What gets used must eventually be replenished. What gets drawn down must eventually be rebuilt. This is where the market must be underestimating the next phase as far as we're concerned. Because while everyone is celebrating lower oil demand today, very few people are asking what happens when China starts rebuilding. Let's think through the math. China is already the world's largest importer of crude oil. If inventories have been drawn down significantly, if strategic reserves need replenishing, if petrochemical inventories need rebuilding, if industrial utilization begins accelerating again, then global oil demand can rise much faster than most forecasts currently assume. And importantly, the demand would not be speculative. It would be physical. It would not be financial. Real barrels, real purchases, real cargoes moving through global supply chains. The market perception of China is that it is acting as an oil price deflector, a force holding prices down, a force absorbing geopolitical shocks, a force preventing a major supply squeeze. But that role is not permanent. It may simply be temporary. And if China's buying behavior shifts, the market could discover that one of the largest suppressors of prices suddenly becomes one of the largest supporters of prices. That's so big, you got to let that sink and you got to write that down. That's a very different environment because oil markets are highly sensitive at the margin. Price is not determined by total demand. They're determined by incremental demand. The last barrel matters most. A relatively small change in Chinese purchasing activity can have an outsized impact on global benchmarks, particularly if supply growth remains constrained, particularly if investments in new production remains weak, particularly if geopolitical tensions persist. And that's why this story matters far beyond oil, ladies and gentlemen. What we're really discussing is a broader shift in the global economic landscape. China has spent years building resilience, building buffers, building inventories, building energy security. Those buffers have allowed the country to absorb one of the biggest geopolitical shocks in recent years with surprising little disruption. But buffers are not infinite. Inventories eventually require replenishment. Reserves eventually need rebuilding. And when the process begins, the market may suddenly realize that the source of today's weakness is becoming tomorrow's demand engine. That's the transition investors should be paying attention to. Not simply whether oil is up or down this week. Not simply whether a headline appears from the Middle East tomorrow morning, but whether the world's largest commodity consumer is preparing to re-enter global markets in size. Because if that happens, the conversation changes completely. And when the conversation changes, prices tend to move much faster than expectations. The biggest opportunities in markets rarely come from volume headlines everyone's discussing, ladies and gentlemen. They don't. They come from identifying the second-order effects before the crowd notices them. This may be one of those moments. The market is focused on the conflict. I'm focused on inventories. The market is focused on disruption. I'm focused on the rebuild. The market is focused on today's demand destruction. I'm focused on tomorrow's demand resurgence. And those are very different conclusions, ladies and gentlemen. China's oil imports have fallen roughly 23% despite heightened geopolitical tensions, ladies and gentlemen. Massive electrification has reduced China's vulnerability to energy shocks. You should be writing all this down. This is free. Strategic crude reserves appear substantially larger than in previous cycles. Large petrochemical inventories have allowed industrial activity to continue with lower crude imports. Current oil weakness may be partly driven by inventory drawdowns rather than structural demand collapse. Inventory cycles eventually reverse, ladies and gentlemen. It's really important. China can move from suppressing oil prices to supporting oil prices through reverse rebuilding and renewed imports. So even modest increases in China's purchasing can have significant effects on oil global benchmarks. What I'm paying attention to and what I think is important: Chinese crude import volumes, strategic petroleum reserve accumulation, petrochemical inventory levels, refinery utilization rates, industrial production trends, electric vehicle penetration rates, shipping activity through the Strait of Hormuz, OPEC production decisions, global inventory to demand ratios. Brent and WTI futures curve structure is very important. See, because when markets are currently pricing China as a source of weak demand, if that assumption proves wrong, the implications extend far beyond oil. High energy prices influence inflation. Inflation influences central bank policy. Central bank policy influences liquidity. Liquidity influences access prices across equities, bonds, commodities, real estate, and digital assets, in other words. Understanding China's oil behavior is not just about energy. It's about understanding one of the most important macro variables that could shape global markets over the next 12 to 24 months. The difference between an inventory drawdown and inventory rebuild may be the difference between a deflationary environment and a renewed inflationary impulse. That is a transition every serious investor should be monitoring closely. See, when you look at what's happening in the market, you see gold at around 42 and change, silver at 65, oil around 88, DXY is pushing higher back to the 100 level. Ladies and gentlemen, the world's in flux. On one hand, you have the overreaction to the hotter jobs. People want to get involved with certain IPOs coming. I think people and money managers are looking for any form of excuses to cycle out of certain positions and into new ones. I can't prove that yet, but we're tracking the flows, and it makes a lot of sense. And I always tell you that Wall Street's a lot like lemmings. Everybody does the same thing, go off the same cliffs, dumpster dive the same trades. Hence, when we saw mortgage-backed securities, which is not even a derivative, it's a derivative back to air, the world imploded. When you find the patterns that matter right now, right? And I felt it was very prudent to talk about crude oil because that's going to influence a lot of things. You redo the same plays over and over and over again so you don't get caught up like sushi. As the remora, we follow the apex predator because we're underneath them. We devour what they devour. You're not trying to spot new plays. That's not how you get ahead in this game. None of this is financial advice, it's just my own opinion. You get ahead in this game through discipline. You get ahead in this game through paying attention to what's quiet. I tell you this because the entire cycle is changing. Why I say that is I look at the contractions in financial markets and they're shrinking. So to me, there are plans behind plans in the markets. That excites me even more because I believe when Operation Print It to Win It begins, we will look back and wish we have acquired more things right now. Ladies and gentlemen, if you're looking to learn how to trade, if you're looking to learn how to invest, if you want to learn how to trade, if you want to learn how to invest, come and join the Crypto Public Desk Monthly and join over 570 active traders and investors. Doesn't matter where you are in your journey, if you're brand new or seasoned. There are reasons why there are certain groups who are successful year in and year out in this game. Come and learn what we were taught in the fall of the New York Mercantile Exchange and better your odds. One tip from the pits can pay for your entire year subscription. But ladies and gentlemen, at least for me, I have this dialed in. I've been seeing what's happening and why. I've been telling you that we are short-term bearish on metals for weeks now. Had you just taken any of what I've been saying here and applied it, not financial advice, just my own opinion, and retained myself an organization in any capacity, you'd be so far ahead of the game. We're buying physical metals. We're going long physical metals. We're going long certain cryptos, XRP, ICP, HBAR. I can't tell you how many concessions we have developed and we're still developing right now that were underwater with the metals when we first took them. There's a difference of staying the course because you know where you're going and you have a plan and just getting lucky every day and then eventually getting cut up like sushi. I want everyone to have a blessed day, blessed evening, wherever you are. Understand this. It pays to be patient. The satellite perspective comes from Gucci conviction, Gucci clarity. We're going to be rewarded for our patience, ladies and gentlemen. With that being said, I wish you all have a blessed evening. Remember, this content is for entertainment, educational purposes only. Should not be taken as financial advice. Never invest based solely on watching any YouTube videos. Always do your own research. The world's changing now. It is. It's whether or not you want to change with it, in my opinion. And you don't have to. I just know out of anything I was ever involved with in finance, this is the pinnacle of it. See, when we first started doing solvent extraction electrowinding over in Southeast Asia, we were the first movers there. Now it's commonplace. People laughed at us at first when we started doing it 20 years ago. They're not laughing anymore. I look at this and say to myself, where the market's going to be after the Clarity Act gets passed. See, we believe, in our opinion, that's the next break fast in this situation to change the narrative. But there being people being put into place because there's plans behind plans to stop the rise of certain assets. I can't prove this, but the math and trading really, really does support it. Really does support on certain financial instruments. The graphs support it. The flows support it. See, when I say we're the remora, we're taking advantage of that. We really, really are. A lot of people are disappointed. See, if you make it to this video, why don't you drop in the comments you're still here, loving the candy from the Italian ice, and tell me where you're watching from, what part of the world. We're not crypto influencers. We're financial mercenaries. We started this entire channel to give back. There was no way that we could ever work with retail because to work with us, you have to be an accredited investor. This is how we give back to retail. So if you found the Crypto Republic and you're here, you are a member of the Wolf Pack. It's just how much would you like to learn? How much you want to consume? Because no good thing lasts forever, ladies and gentlemen. It doesn't. You need to take advantage of while it's still here. With that being said, it's going to be very interesting to see what happens, how the response from the United States is over with the Apache helicopter being taken down. But I told you, we have been positioning in a variety of markets for this. I identify here the plays that we are looking at inside the Crypto Republic Desk Monthly and our Patreon. We go over the exact things of how we are playing them. With that being said, I love you all. Make sure you do not get cut up like sushi. Whip out that frosty beverage, because this frosty climb up this frosty mountain is going to get a lot more hairy right now. Keep the conviction. Keep the faith. Don't forget why you started. I love you all. I'll see you tomorrow at 1:30 in the afternoon, New York Eastern Standard Time. Have a blessed evening.